Welcome to Community CPA's channel. Today's topic is asset protection using LLC. So a lot of our small business owners made a fortune. When we talk about fortune, we meant to say that we have an operating business. In our business, we have asset. Then outside of that particular business we are running, and we also have rental properties. We bought a couple residential buildings. We also have plazas, malls that we own. Those are investment properties. Then we also have personal savings, stock market investment, all of these, right? So those are the asset. Those are worth of protection. The goal of today is to figure out how to proactively protect your asset using LLC. To recognize ownership and risk, so one problem does not unnecessarily threatening everything else you have. What does asset protection mean? Asset protection equals to risk separation plus planning before a problem happens. Asset protection has to be proactive. If you already have something going on, then you start doing all of these things you are doing. You need to plan before a problem happens. Asset protection generally means separating risky asset from safer asset, limiting exposure from lawsuit, death, or claims, using legal entities, insurance, contract, good records to protect, planning before a claim or creditor issue rises. So these are what asset protection means. Asset protection does not mean hiding asset, evading taxes, defrauding creditors, ignoring debt, or legal obligations. These asset protection in plain English just means that if something goes wrong in one part of your life, you want to reduce the chance that spills over into everything else. So a tenant slips and falls at a rental property, and your contractor sues over your business dispute. A customer claim rise from business operation. All of these throw a monkey wrench into part of your life, your business life. But you want to reduce the chance for that to spill into your personal life. So basically, transferring asset after a lawsuit or creditor problem began can create fraudulent transfer or avoidable transaction issue. A good asset protection plan combines multiple tools together, LLC being a number one. Why LLC are commonly used? LLC is the easiest, cheapest to establish. LLC stands for Limited Liability Company. A LLC may help separate business liability from personal asset, rental property liabilities from personal savings, and one property's risk from another property. So if you have one property in one LLC, another property in another LLC, so you're separating one property's risk from the other property's equity in case that property was paid off by you 100%. Operating business risk contained in the LLC from your other investment asset. So if the LLC is properly formed and operated, claims against the LLC generally should be limited to that LLC, not anything outside of the LLC. So this is why LLC are commonly used. What a LLC does not protect against. LLC is not a force field. If the owner personally causes harm, signs personally, or guarantees a debt, the LLC may not protect the owner from that liability. So a common example would be a bank loan to buy a rental property may require the owner to personally guarantee that mortgage. If the loan defaults, the lender may pursue the owner personally under the guarantee, even though the lender do respect the LLC wraparound, but because you signed a personal guarantee, that's why it's pursue you personally. Another example I have is that if the owner commingles LLC and the personal funds together, LLC planning should be paired with understanding of the signature you are putting on paper and understanding of how you are bookkeeping your LLC. So formality matters. And also, worth mentioning, you owe payroll tax and you owe sales tax inside of your LLC operation. Those taxes are trust funds, so they don't go away even when you file bankruptcy for LLC. So they don't. You're personally liable for that. Fraud, improper transfer, those are do not protect you. Okay, the claims where the LLC was not respected as a separate entity because you commingle funds, those do not offer protection. So underinsured or uninsured losses. So the LLC do not protect you losses if you did not insure yourself properly. So those are the protection LLC don't offer, and I want you to be crystal clear in your mind the limitation of LLC. A lot of times our client will ask me about single member LLC, multi-member LLC. In a family with a couple, it is sometimes okay to do a single member LLC because you love each other so much you don't care who is the owner of the LLC. But you also sometimes want both of you to be in the LLC, then you become multi-member LLC. You might just always kind of wonder, okay, what is the best for me, right? So let's understand the single member LLC is one owner, which is simple to form and to operate. Okay, often is filed as disregarded and entity to your federal tax return. A lot of time it goes into Schedule E and Schedule C, and it's just part of your 1040, right? So this asset protection piece to a single member LLC, it varies by the state. So I want to put that here for you. It's just because the LLCs are so related to the state. When you are working, forming, or thinking of using LLC to protect your asset, making sure that you form the LLC accordingly based on the state law and which state protects you better. If you have creditor concerns, for example, you borrow a lot of money and you have creditor concerns, then you may choose different state to form your LLC. But of course, it's not as simple as you just go ahead, form an LLC in Wyoming, then you're all set. No. And it's also related to whether your business is there. So for example, if you have a rental property in California, even if you form a LLC in Wyoming, that you still have to report your California property in California. So, when you get into litigation, yes, they're going to go for Wyoming, but you also located in California. So that's also restricted you from certain protections that you think Wyoming is offering you, but the California would not have. So with that kind of thinking, you want to always know where you're going to form that LLC. So state law is really important. You want to engage the attorney to understand what's the difference, right? Multi-member LLC means two or more owners, usually taxed as a partnership, is not a disregarded entity. So the operating agreement becomes very important, even if you are a couple, because that operating agreement would shield someone from liabilities, will expose another person to certain liabilities. That is how significant that is. So it has a very different creditor remedy treatment, depends on the state law. So with that said, you want to kind of understand. Then you may say that if that's the case, why would we even bother with a multi-member LLC? That might be super important in a operating entity. For example, you run a restaurant under LLC, and you are the cook, but you have a operating manager who is another owner who runs the payroll, who does the sales tax, who do all of these things for you, and you just stay in the back and cook, but you own 60%, this person owns 40%. So if you get into, claim, for example, government come to audit you, you owe a whole bunch of payroll taxes, you owe a whole bunch of sales tax, then that person who operates the restaurant, even though they have 40%, it will be liable for that amount owed, which is personally liable. But you, on the other hand, was in the back, not involved with the operation. You have a limited risk to that. So you may not subject to that kind of liability, right? So it is important. LLC has so many layers and details that you want to consider, especially if you got into business with your friends and you're ready to destroy the friendship. So you got into a business, make sure you do a good operating plan, form a multi-member LLC to take care of the situation where in case you split up, in case you don't like each other anymore. There is a saying goes, right? If you want to break up your marriage and if you want to break up your friendship, you go in business together. Not always true. Structuring rental property. So there's so many ways you structure rental property. So when you have one LLC, you want to put similar things in together. For example, you and your friend has been acquiring properties together, and the property is also a single home property. So the risk is similar, the ownership is the same. Then you form one LLC, put all of that kind of house in one place. But let's say you yourself acquire commercial properties on your own. Then you put all your commercial properties in one LLC because you are yourself, so you are here. But what if your commercial properties are located in different state? Then I would form different LLCs in different state. Even though it is a similar commercial property, the risk is similar. Just because every state has different rules and regulations, so your property is already in that state, you're going to file that state LLC taxes anyway. So why not just separate LLC, make it simple so you don't have to have one tax return with multiple state return, getting the state audit risk going up and all of these things. Of course, if you have a whole bunch of LLC, I also would recommend you to set up another LLC to operate the rental business. So that way you have an operating entity who has no properties inside, but just managing the management of it. Then you have all your LLC be the title holding, so your tenant don't even know those LLCs. They only know that operating LLC. That operating LLC can be elected to be an S corporation, so you don't have to subject to self-employment taxes. There's so many things that you can do, right? So structuring rental property is an art piece. You want to think of that carefully and making sure that you're selecting the best for yourself. Similar risk level is a consideration. Similar property type is a consideration. Similar equity level is a consideration. Because if your single home is all paid off and you want that to not commingle with the one that you have 90% of it is still a loan. Right? So those are consideration. Financial arrangement is a consideration. Sometimes the lender goes, oh, well, I'm not going to give you the loan if you don't give me certain collaterals. To have that collateral in one LLC, you have to bring that maybe fully paid property into the LLC so this LLC can have a proper financing. Then let me give you an example of structure. So John operates a small lawn mowing company. He owns 2 rental properties and a personal saving account and a Robinhood investment account. So what he did is he opened up a LLC to just operate his business, lawn mowing business. This have a separate bank account, and he is the owner, and he runs this business. And he also buy general liability insurance to cover. And he has a couple lawnmowers, not expensive, but he also bought insurance for them. Rental property number 1, he has 2 properties, right? Number 1 is a rental property LLC number 1 because that property is in California. Then the other rental property 2, it is LLC number 2 because that property is with him in Wisconsin. So he just separated them out. He didn't group them. So his personal saving account is under his personal name, is outside of these LLC. He does not commingle his personal money with his operation, so it's totally separated. And he has insurance for his rental property. The tenant buys the content insurance, and he buys the structure insurance to make sure that is in case it burned down and it can be replaced, it can be built again. He also have bookkeepers to run bookkeeping on the LLC 1, LLC 2, and also the operating lawnmower company. So the accountant does 3 sets of book for him and do reconciliation, file taxes for him. So this would be a solid asset protection. There's no need to spend a fortune trying to get an expensive lawyer, do this trust, that trust. There's no need. And you got that all covered. You have your tax protection already here. So what you should do as a small business, list your asset and the risks. Know your asset, know the risk. Maybe you own a piece of jewelry. What's the risk? Small. If you don't take it out of your home, if you put in the safety box, you don't have a risk. It's going to be there, right? So you have a vehicle, you have a risk. So you want to make sure that you understand your asset that you care to keep. Then you understand the risk affiliated with the thing you care to keep. And review ownership. Know the ownership. And sometimes you borrowed a bunch of money on that asset, for example, property. the ownership is probably belongs to the bank, but you want to understand the ownership, who owns the property today. Review the debt and the guarantees. Don't lightheartedly sign your name on a piece of paper. You need to look at the signature block to see what you are signing for. You may sign for LLC. That is okay because somebody has to sign for the LLC, right? LLC don't have a signature, don't do signature themselves. So you sign as a member of the LLC, but you do not sign as a personal guarantee as a guarantor, right? So those signature block, you need to read them. That's really important. And check your insurance coverage. Make sure that insurance is enough. You really did a good insurance. Make sure you have a coverage for each property and umbrella. Evaluate LLC structure to see whether you should layer them up or you should have just one to simplify your life. So structure is something to visit. Clean up formalities. That is your action list. Common mistake that will weaken your LLC protection. Number one, forming an LLC but not moving your property title to it. That is the number one mistake. So if you form an LLC to have a rental property stay there, make sure the title is in the LLC. No operating agreement when you have multiple members. And you only use one bank account to track everything, including your own baby diaper purchase. Okay? Paying your personal expenses out of LLC. Signing contract personally instead of as LLC member. That signature block, you really need to read. State filing, you don't do it. You forgot. That SOS filing is very important so it doesn't become administratively dissolved. Inadequate insurance is another one. Putting too many assets in one LLC is definitely not recommended. Those are common mistakes. Ignoring personal guarantees, just sort of like you pretend you didn't even have it. That is common mistake for LLC because you thought you got a protection, then goes, oh, yes, there's a personal guarantee on it. Yeah, don't forget, don't ignore. It is important. If you have personal guarantee on certain loan that belongs to your LLC, then you should know that is a risk. That is something you need to consider when an event happens. Okay, and waiting until after a lawsuit or debt problem rises, then you go, oh yeah, I want to form an LLC. That's too late. Okay, it doesn't work. Don't wait too long till major issue happen. Then asset protection will be useless. All right. So this is our website, communitycpa.com. And you notice that we have this on board with us button. If you click that button, and you will sign up with us 24/7 whenever you have time through this button, then we will get back to you and get you connected with the right team member to help you out. So we have 6 partners, 2 managers listed on our website. 6 partners were all in different area of practice. So Dr. Hao and one of the partner, and he is legal compliance and the immigration side of work. And Dan Kim, another partner, he's in charge of client service of market development. Juan, specialty in payroll accounting, sales tax. Song, he is our attest partner, handles audit. And Derek is our IT network architecture and IT partner. Tiffany is our tax manager. Eileen is our accounting and audit manager. And this is YouTube channel. We always deposit all of our webinars into here. And I hope that you will subscribe to our channel so you always get notified what we have for you next. And also, if you like our video, give a thumb up. Last, no responsibility disclaimer. Of course, all our webinars are for educational purposes, and it is not the tax, legal, accounting advice because those advice need to give to you customized. We need to know who you are before we can finalize what is the advice. And be sure to review any decision with your CPA, your attorney, your tax advisor, or with community CPA before you put that in action. All right, I'll talk to you again